Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Christine Benz details what investors should have on their radar for mid-year portfolio reviews. Sarah Bush highlights 3 individuals awarded for investing excellence. Jackie Cook breaks down the basics and importance of proxy voting. Ben Johnson discusses how fund fees have contracted in recent years. And Russ Kinnell shares his favorite foreign large value funds. Let's get started. Here are Susan Jabinski and Christine Benz from Morningstar, Inc.
Hi, I'm Susan Jabinski with Morningstar.com. It may seem difficult to believe, but we're almost at the halfway point of 2020. And this is the time of year when investors take a look at their portfolios and do a mid-year portfolio check-in. Given how volatile the market has been this year, we're going to have a talk today with Christine Benz, our Director of Personal Finance, to get her take on what we should be looking at as we do our check-ins this year. Christine, thank you for joining us today.
Susan, it's great to be here.
Now, it certainly has been a bumpy ride this year. What should we have on our radars as we're starting to take a look at our portfolios?
Well, I always like the idea of putting a kind of a wellness check at the top of the list. If you're looking at a portfolio checkup, start with the health of your plan. So if you're someone who's in accumulation mode, the key metric there is that you're looking at your savings rate. Obviously, we're in an environment where a lot of people have seen income disruptions. So maintaining a savings rate in line with what you had hoped to do at the outset of this year may not be attainable. But if you are still employed and still on track with your savings, look at whether you are on track to max out your tax-advantaged vehicles if you can. Just check up on how you're doing in terms of your retirement trajectory. If you're someone who's already retired, the key metric of your plan's health is your withdrawal rate. And we have seen a great snapback in the equity market, so a lot of portfolios have made a great comeback as well. That means that perhaps the warning lights aren't necessarily flashing in terms of reducing withdrawals, but I think retirees want to be mindful of that idea, especially if they're just embarking on retirement. And the key reason is that we've seen yields drop really low on bonds and certainly on cash. And that means that the raw materials for balanced portfolio returns may not be that great over the next decade. So check your withdrawal rate. We did an interview with Wade Pfau, who is one of the gurus in retirement research and on retirement withdrawal rates specifically. And he argued that 3% as a starting withdrawal rate is safe for new retirees. Take a look at where you are coming out in terms of your spending so far 6 months into the year.
And the next step you recommend is that people take a look at their asset allocation, specifically at their allocation to sort of those safer, more conservative investments. What should we be thinking about here?
Absolutely. It's a great time to check up on your portfolio's cash reserves, your liquid assets that you could draw upon in a pinch. We've certainly seen in stark relief through this crisis where people have had income disruptions, income losses, they've lost their jobs. So for people who are still in their accumulation years, it really is well worth checking to see how you're doing with respect to your emergency fund. The standard rule of thumb has been 3 to 6 months worth of living expenses that you have parked in highly liquid assets. I would say for some workers, maybe contract workers, people working in the gig economy, we see through this crisis how that should probably be a larger number for a lot of households. So check up on your cash reserves. If you're someone who's retired, you need cash too. I would argue that retirees should think about having a couple of years worth of portfolio withdrawals parked in safe assets. The idea is that if it's not a great time to withdraw from stocks, it's maybe not a great time to withdraw from bonds, you'll have your cash reserves that you can draw upon instead. So take a look at those cash reserves, make sure that you have those liquid assets.
And pivoting a little bit now to those longer term assets, what should we have on our radars there? And are there any particular benchmarks or guideposts that we should be looking at?
Here, I think our X-ray functionality that we have on Morningstar's Portfolio Manager tool is really invaluable in terms of getting your arms around your total portfolio's asset allocation. So take a look at that. If you have not made any changes recently or even for a few years, you may find that your portfolio is actually too aggressive given your life stage, especially if you're someone who is within maybe a decade of retirement, or certainly someone who is within a few years of retirement. You do need to de-risk the portion of your portfolio that you expect to spend from soon. So take a look at that asset allocation using X-ray. You might use a target date fund, especially if you're a younger accumulator, to try to make sure that your asset allocation is in the right ballpark. For younger investors, they probably will find that target date funds are recommending 80-90% in equities, and certainly if they can withstand the volatility that comes along with a higher equity allocation, they should be up in that very high range of equity exposure, mainly because bond yields are really low today, and that foretells pretty poor returns from bonds over the next decade.
So in addition to sort of that stocks, bonds mix, that overarching asset allocation that we'd look at, what are some of the other things we should go a little bit more deeply into the portfolio and look at?
Well, here again, I think X-ray can help you get your arms around your portfolio's investment style exposure. We're in this period where we've seen absolutely tremendous performance from large growth stocks, technology stocks in particular. Those big name tech stocks have really been pacing the market. If we haven't been paying close attention, our portfolios may be drifting up in terms of their exposure to that top right-hand square of the style box. So take a look at that. Take a look at whether your portfolio isn't disproportionately skewing toward large growth stocks. Also look at your portfolio's geographic exposure, because we've generally seen U.S. stocks outpace foreign stocks year to date. Younger investors especially, but really investors at all life stages, should have ample allocations to non-U.S. stocks as well as U.S. stocks. And finally, take a look at individual stock exposure. Certainly if you have employer stock, it can become easy to be overweighted in your employer's stock. And if you're lucky enough to still have a job, you probably don't want too much of your financial wherewithal riding on your employer's fortune. So drill into the asset allocation, drill underneath asset allocation to look at some of these other factors as well.
And you know, we talk at Morningstar a lot about costs and how costs over time can really erode your returns. So how can we incorporate a cost audit into our mid-year checkups?
Right. Our colleague Ben Johnson just put out a great report looking at the trends in fund fees, and what we see is that fund fees are coming down and investors are choosing cheaper funds. So if you haven't taken a closer look at your portfolio with respect to how much you're paying in mutual fund fees, take a look at that. It may be that you can obtain the same exposure at a lower cost by swapping into a broad market index fund or an ETF, or a cheaper active fund if you prefer to go to the active route. Look at the whole gamut of costs though. Don't just start and end with fund fees. Look at how much you're paying financial advisors, how much you're paying in brokerage commissions. Also take a look at implicit costs that you might be paying. So we talked about how low yields are today on cash. Well, they're especially low in certain types of accounts. Brokerage sweep accounts, I would point out, have notoriously high costs and low yields. So if you have cash holdings in your account, make sure that you're not ceding too big a share of your yield to expenses.
And lastly, Christine, you've talked before about the importance of tax efficiency, and how can we perhaps be thinking about taxes or doing a tax audit as part of a mid-year portfolio checkup?
Right. Do a quick review of this, and mainly that starts with looking at whether you are taking maximum advantage of those tax sheltered accounts that you have available. So IRAs, you actually have until July 15th to make an IRA contribution for 2019. So take a look at that. Take a look at how you're funding your company retirement plan. Also take a look at whether, if you have non-retirement, non-tax sheltered accounts, whether you are investing those as tax efficiently as possible. So do you have index funds there? If you have bonds in your taxable account and you're in a high tax bracket, do municipal bonds make more sense for you? And finally, one thing we've been hearing a lot about from planners we talk to is the idea of looking at Roth conversions in 2020. I would say retired investors who don't have to take their required minimum distributions this year are particularly good candidates for taking a look at whether conversions might be in order, might make sense for them. That particularly makes sense for people who have IRA assets that they don't expect to spend during their lifetimes, where they're saving in those accounts mainly for their heirs. In that situation, get some tax advice and see whether converting part of those assets might make sense for you.
Christine, thank you so much for the concrete steps that we can take to make sure our portfolios are on track mid-year. We appreciate your time.
Thank you so much, Susan.
I'm Susan Jabinski with Morningstar.com. Thank you for tuning in.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa. Now, Christine Benz from Morningstar Inc. and Sarah Bush from Morningstar Research Services.
Hi, I'm Christine Benz for Morningstar. Morningstar recently named the winners of its Awards for Investing Excellence, selecting 3 winners in 3 categories. Joining me to discuss the award winners is Sarah Bush. She's Morningstar's Director of Manager Research for North America. Sarah, thank you so much for being here.
Thanks for having me, Christine.
Sarah, let's start by discussing the thesis behind these awards. What are you and the team trying to do by making these awards each year?
Sure. So what we're looking to do is to recognize extraordinary investors, recognize commitments to shareholder best interest, and also those who have been willing to differ from the consensus. The awards, the first 2 awards honor portfolio managers, and the first is the Outstanding Portfolio Manager Award. You can think of this as a Lifetime Achievement Award. We're looking to honor a manager who has really produced exceptional results for investors over the long haul. The second award to portfolio manager is the Rising Talent Award. So here we're looking for someone who is earlier in their career, a manager who has less than 7 years of experience, who's already shown exceptional promise and generated strong results, but kind of looking ahead to their promise as they go through their career. The final award is our Exemplary Stewardship Award. And here we really are looking at the asset manager. And we really want to identify asset managers who've shown, an unwavering focus on investor interests, which is very important as we kind of look at our methodology and understand what drives good fund performance over time.
So let's take a look at the Exemplary Stewardship Award. There were 3 nominees for 2020. They included T. Rowe Price Capital Group, which is the parent company of the American funds, as well as Dodge & Cox. Let's talk about the award winner in this category.
So the award winner is T. Rowe Price, and we've awarded this honor to T. Rowe Price to recognize its strong investment culture that's allowed to flourish in a very difficult environment for active managers. T. Rowe Price is an equity powerhouse and also has built a very strong target date franchise. Investors in its funds have benefited from long tenured managers. They've been very thoughtful about manager transitions, managing capacity, and just investment alongside investors, alongside shareholders. One of the stories that came out as we were talking about T. Rowe Price, which I thought was really interesting, is that David Giroux, who is a portfolio manager and head of investment strategy at the firm, recently led a firm-wide initiative to look at how to improve the life of analysts. And this is a firm that has, one of the things we think is really impressive about it is it really does have this very deep analyst bench. So we went out and spent a huge amount of time talking to people across the firm and came out of that experience with some very concrete measures. A couple that our analysts have told us about are, finding ways to find deep thought time during the day, so you're not, just when you're disconnected from email and from other potential distractions, and also just sort of solidifying expectations around, what needs to go in an analyst note and how analyst and portfolio manager interactions happen. So that's just an example. This is a firm that has really innovated, puts a very high emphasis on that investment culture and getting it right, and really thinks it's very important, can build our analysts and portfolio managers can work and invest across their entire careers.
Now let's talk about the award for rising talent. There were 4 nominees in this category. They included John Dance from Fidelity, Wyatt Lee from T. Rowe Price, John McClain from Diamond Hill, as well as Mohit Mittal from PIMCO. Who was the winner in this category, Sarah?
So the winner was Mohit Mittal. He's named a manager on a number of strategies, including PIMCO Investment Grade Corporate, where he's been since 2016, and was actually recently, in late 2019, named as portfolio manager on PIMCO Total Return. It's a very well-known fund, very important to the PIMCO franchise, obviously, and I think that speaks to the confidence that the firm has in Mohit. What we see in him, so Mohit is the firm's corporate credit, leads the corporate credit portfolio manager team, and has really done a lot, both sort of as an individual investor, but also to build that team's capability, both to dig deep and find ideas that work in smaller corporate dedicated strategies, but also to think about how to leverage the firm's corporate research to make decisions that impact the larger, more diversified portfolios, such as PIMCO Total Return. I mean, he's very, very much impressed us in his time managing money. Our analysts point to his analytical talent, his quantitative skills, and drive. It's been key to his success at PIMCO. And we all know that PIMCO is a famously competitive organization. So those skills and talents have served him well in his career so far, and I think will in the years to come.
Now let's discuss the Outstanding Portfolio Manager Award, which you describe as being akin to a Lifetime Achievement Award. There were 5 nominees in this category: Chuck Akre, Joel Tillinghast from Fidelity, Mary Ellen Stanek from Baird, Jerome Clark from T. Rowe Price, as well as TCW's Fixed Income Management team. Let's talk about the winners in this area.
So the winner was Jerome Clark. So Jerome Clark is a pioneer of the target date industry. He helped build T. Rowe Price's target date lineup starting in 2002, when there were still just a handful of target date funds. Our analysts cited his commitment to innovation and also the research-driven decisions that team makes into asset allocation. So over his time running the funds, he took them from a fairly straightforward mix of U.S. stocks and bonds to a much more globally diversified portfolio. Those were all very well researched and documented decisions as they made those tweaks along the way. Through that time, a hallmark of the funds has been a high allocation to equities, and that really reflects Clark's view and the team's view that the biggest risk to retirees is that they do have a savings shortfall, that they outlive their savings. So that's been something that's been very important. He's been a steady hand running these funds. He managed them through the global financial crisis, which was obviously a difficult time to have a lot of your target date fund in equities. And, I think he was a steadying presence during that time and actually took up the opportunity to opportunistically add to the fund's equity allocations during that time, which obviously turned out to be a very good decision and is one of the big drivers of the strong records that those funds do hold today. So overall, this is a series that has top-notch returns, and today it has more than $200 billion of assets. So the strength of the calls that he's made has really had a wide impact on a lot of different investors and their retirement savings.
So overall, a really worthy slate of nominees and award winners. Sarah, thank you so much for being here to share them with us today.
Thank you very much for having me, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed. Next, Tom Lauricella of Morningstar Inc. and Jackie Cook from Morningstar Research Services.
This is Tom Lauricella from Morningstar, and I'm here with Jackie Cook, Director of Stewardship Research at Morningstar, to discuss how proxy voting works and why it matters. Jackie, thanks for being here today.
My pleasure.
So let's start off with the basics. Proxy voting is something that can be a little bit inside baseball when it comes to the investing world. Many investors might come across the term here or there. At the same time, it's something that, even if it's not the most common term among individual investors, that is becoming more and more important in the investing world at large. So why don't we start off by just explaining a little bit about how proxy voting works and what it is?
Proxy voting gives investors voice. It gives them a say in the governance of companies in which they invest in their portfolios. Most classes of equity shareholding give investors some sort of voting rights, and these rights can be used to cast votes on proxy ballots that companies issue before annual and special meetings. And typically these ballots contain a variety of items that help investors shape corporate governance and strategy at the companies.
So proxy voting could it just be simply another way to say that as a shareholder in a stock, you're able to vote in how that company is run? Is it really just as simple as that, even if the word proxy might be a little confusing?
Yeah, so the word proxy really is, it's the default. So very few shareholders show up at the annual general meeting in person to cast their votes. They usually cast their votes by proxy, by mail or online. And so the term proxy voting is really the default term for shareholder democracy, I guess.
Got it. So if I invest through mutual funds, how does proxy voting work there? I don't actually own these stocks in my own account. I probably don't get these. I'm not going to be actually getting these ballots mailed to me. How does it work in that case?
Well, yeah, so that's a good question, because as a fund shareholder, you don't actually hold the vote. Your fund holds the vote and votes and casts that vote on your behalf. And your fund is obligated to cast that vote in your best interests as a fiduciary. So often what happens with funds is, voting is actually a strategy that's set more at the fund provider level, at the asset manager level. So individual funds in which you invest, their voting strategy will align more with the voting position of the asset manager offering that fund. Sorry, I should just point out, with respect to index funds, the degree to which individual fund managers will have sway over that vote is far reduced, because voting strategy is typically much more centralized.
So the key here is that when I own a mutual fund, the mutual fund company is casting those votes on my behalf and on my interest. And so if I'm an investor with a particular point of view on anything, it's really going to be in the fund manager's hands. It's going to be their view on how to handle a particular situation at a company.
That's right.
Okay. So how about if you give us some examples of proxy voting resolutions that can hopefully shed a little bit more light on what this term means?
Right, on how shareholders are able to have an impact on corporate governance. So, if you take a proxy ballot, let's take just a typical proxy ballot that would be issued prior to an annual general meeting of a large public company. That ballot probably contains around 15 items, 10 of which would be, approximately 10 of which would be electing the directors of the board of directors. Usually companies offer investors an advisory vote on executive compensation. And on every annual general meeting ballot, you'll also see an item that gives investors an opportunity to ratify the selection of the auditor for the following fiscal year. On many large public company ballots, you'll also see items that are placed on the ballot by shareholders. And these are items that more specifically get to the governance of environmental and social risks at the company. So whereas you can shape corporate governance by voting across the board of directors and voting a thumbs up or a thumbs down on executive pay, the ability of shareholders to file shareholder resolutions and have those appear on the corporate ballot really helps shareholders shape the conversation around corporate governance and the governance of environmental and social risks.
So, and investors may have now heard the term sustainable investing. How does proxy voting relate back to sustainable investing? And can you give us some examples of some resolutions that might be related to that particular area?
Right. So sustainable investing, so proxy voting isn't necessarily sustainable investing, but it's certainly an essential part of sustainable investing. It's hard to argue that you're a sustainable investor if you're not taking into account the impact of your proxy votes. And I'll give you some examples. Even if you're casting your proxy votes across management ballot items, you're still shaping how well a company manages environmental and social risks. There are examples of where shareholders have run campaigns against certain against certain directors up for nomination for a board, where that director has failed to navigate important social and environmental risks on behalf of the company, or where, for instance, executive pay might be completely out of whack with the median worker pay at that company. So it's important that to make the point that proxy voting across the ballot is a question of sustainable investing. And particularly when we get to the shareholder resolutions on the ballot, there you see these issues being more explicitly dealt with. And I'll give you some examples of the issues that come up. One very important issue for shareholders is how companies are preparing for the low carbon transition. So many shareholder resolutions ask companies to set and disclose what their greenhouse gas emission reduction targets are. Another group of shareholder resolutions ask companies for transparency into their corporate political influence, how they spend corporate money lobbying or contributing to campaigns, and their affiliations with trade associations that do this lobbying on their behalf. So trade associations have been lobbying actively against worker protections and climate policy. So this is one area in which sustainable investors want to be really mindful. And some other examples are diversity, workforce diversity, gender pay equity. These are all the types of issues that come up for vote on proxy ballots.
Okay. So does proxy voting make a difference?
Yes, it does. So, a lot of folks have looked into, a lot of academics have looked into the impact of proxy voting. And, often it's not easy to say this particular vote caused this particular change at a company or this particular change within the market. It's an iterative process. And a lot of shareholders who run shareholder resolution filing campaigns, for instance, take a long view of their campaigns. But proxy voting does make a difference. It's about investor vigilance, and therefore it benefits the entire market to have investors that are monitoring what's going on at the company and how well the company is managed. And it's part of the ecosystem of checks and balances. So, for instance, it's not the only way that investors can influence corporate governance at companies. Another way is by engaging directly in dialogue with the company. But of course, the vote underscores the position that an investor has in dialogue with the management of the company.
Okay, so for the individual investor, then who's watching this, then the question is, how do I make a difference? How can I have an impact anywhere in this process?
Yeah, and that's a good question because more and more people want their investments to align with their values, and so you want to invest, for instance, in a sustainable fund. Well, if you look closely at the fund's proxy voting record, you want to see that proxy voting record aligns with your values as well. And sometimes it doesn't. And then you want to consider, am I in the right fund? For investors that, are in index funds, for instance, and they have choices between some very similarly shaped index funds, when you start looking at the proxy votes of the funds cast, you see that they actually can be quite different in their voting on sustainability. or in the impact that their votes have on sustainability. So it is important to know the votes that your fund is casting on your behalf. And when you know those votes, and for instance, you might feel that these votes should be cast differently, reach out to the fund manager or the asset manager. Make your views known. There is an interesting platform called yourstake.org that facilitates this kind of communication between the fund investor and the fund itself. And then thirdly, vote with your feet. If you're not happy with how your fund's voting, if you really are concerned about, for instance, climate change, and you're concerned that companies are not moving quickly enough on climate change, and your fund voted against a climate resolution, a resolution asking an oil and gas company to be transparent about how it intends to reduce its carbon emissions, then you may just want to look for an alternative fund.
Great. Thanks very much, Jackie. This has been very helpful. Jackie Cook, Director of Stewardship Research, thank you for being here today.
My pleasure.
Now, Ben Johnson from Morningstar Research Services discusses how fund fees have contracted in recent years.
Hi, I'm Christine Benz from Morningstar. Fund fees have been declining for 2 decades, and that trend has been accelerating in recent years. Joining me to provide some color on Morningstar's just released fund fee study is Ben Johnson. He's Morningstar Director of Global ETF Research. Ben, thank you so much for being here.
Thanks for having me, Christine.
So Ben, let's talk about the trend toward lower fees and put some historical context around it. You say that the typical asset weighted fee that investors pay is the lowest that it's been since the turn of the millennium. Let's talk about where they were then, where they were 10 years ago, and how that compares to where we are today.
Well, if you look at the asset-weighted average fee across all funds in 2019, it stood at 0.45%, and that is nearly half of what it was going back 2 decades ago. It's 38% lower than it was going back just 1 decade ago. So while this is a trend that's been in place now for about 20 years, it's really accelerated. It's gathered a head of steam over the course of the past 10.
Okay, so you look at average asset weighted fees, and there are really 2 components to that. One is that it's the fees that funds are charging, but also investor choice. And so let's talk about what has been the bigger driver of this trend toward lower asset weighted fees.
The biggest driver has been investor choice. It's been a very democratic process. Investors of all stripes have been voting with their investment dollars and allocating more of those at the margin towards lower cost funds or lower cost share classes. Now, if you look underneath the surface of the broader trend, there's some smaller trends afoot that have helped this to gather momentum. One of those, I think very importantly, is an evolution we've seen in the advice space, most notably the evolution of the economic model of advice. As more and more advisors have moved from transaction-driven, commission-based models of conducting their business towards fee-based advice models, they've preferred to use lower-cost funds on behalf of their clients. They've also been generally preferring to use lower-cost share classes that don't have embedded in their fees some component that goes to compensating the advisor and not necessarily the portfolio manager or the asset manager that's manufactured that investment product. The other important trend we've seen is the evolution of the retirement savings space. And increasingly what you see is that many Americans in their 401k plans are opting into a default option that oftentimes is a target date fund that's made up of very low cost index mutual funds, which now comprise the majority of all target date fund retirement assets. So these 2 big trends, one in the advice space, the other in the retirement space, I think are further adding fuel to just a general widespread adoption of investors preferring low cost funds. And a lot of that has to do with the fact that the cat's out of the bag, that investors more broadly are realizing that every penny they pay out in fees is a penny that goes to someone else and doesn't compound to their own benefit between now and whenever they are going to withdraw those funds to spend against their long-term goals.
One cautionary note that you sounded in the report was that even though fund fees paid by investors have been declining, all-in fees may not necessarily be declining. So let's talk about that aspect of this trend.
I think it's important that investors understand that not all of these fees are just simply dissipating. They're not evaporating out into the atmosphere. They're not necessarily pocketing each and every penny that's come out of fund fees. Some of these fees might be, in certain circumstances, simply getting displaced. And I think most prominently, this could be the case in certain advisory relationships. So for those investors who are working with an advisor, some of the fees that they may have been paying directly in the form of fund fees may actually just be going from one pocket to another and now getting paid out as advice fees. So I think it's important that investors ask pointed questions of their advisors. Ask them how they're getting paid, how much they're getting paid, and what exactly they're paying them for, to understand how much of these headline savings are actually accruing to their benefit.
Now, we've seen this market sell-off, certainly in the first quarter. The market recovered, now some volatility again. How do you expect that to affect the trend toward lower fee funds?
I think the sell-off we've seen in the first quarter of this year, if anything, might only further accelerate this trend. Effectively, what the downdraft in the market did was give many investors a get-out-of-jail-free card of sorts. There are many investors that for years now in a long bull market had been locked up in positions and funds where they had large embedded taxable gains. We saw many investors take the opportunity that was presented to them, as painful as it might have been, to sell some of those positions during the market downdraft, to realize some tax losses in the process and reallocate some of that money towards lower cost funds. So if anything, I think at the margin, episodes like we experienced in the first quarter of 2020 serve to only further accelerate this trend towards lower cost funds.
What do you think the future holds in this space? Do you think that the excess has been wrung out already, or do you think that there's more gas left in the tank in this trend toward lower fund fees?
Well, I think there's still plenty of gas left in the tank, Christine. Certainly, if you look out over the funds landscape, there's billions of dollars that are still invested in relatively high cost funds, which isn't necessarily bad. There are funds out there that deliver value for their investors and take a fair share in fees. But nonetheless, I think this trend will only continue. I think many funds will have to take a long, hard look at their fees to be competitive and ultimately cut them. And what we're seeing also is that more and more asset managers are experimenting with a variety of different things. On the one hand, we're seeing experimentation in the form of different fee structures, be those performance-based fees, or in some cases more recently, effectively a loyalty fee program whereby fees will ratchet lower for investors each year that they hold a given fund. On the other hand, we're seeing asset managers experiment with new formats. Notably, this year, we've seen a raft of new launches of actively managed, non-transparent ETFs, which are much more fee efficient and potentially much more tax efficient than traditional open-ended mutual funds. So I think the trend that's been in place now for the past 2 decades will only continue. And I think the asset management industry will continue to evolve. And I think net, the benefit will continue to accrue to investors is asset management firms compete for their hard-earned savings. Investors have a lot to celebrate.
Okay, Ben, lots of data, lots of research packed into this report. Thank you so much for being here to discuss it with us.
Thanks for having me.
Thanks for watching. I'm Christine Benz for Morningstar.
Expand your investing horizons and look to the long view with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance Search for and subscribe to The Long View today. And lastly, here's Russ Kinnell from Morningstar Research Services.
Hi, I'm Christine Benz from Morningstar.com. For investors looking to reposition their portfolios after a strong rally in U.S. growth stocks, a couple of themes stand out: foreign stocks and value. Joining me to discuss why those areas might be worth a look, as well as to share a few picks that converge around those themes, is Russ Kinnell. He's Morningstar's Director of Manager Research. Russ, thank you so much for being here.
Glad to be here.
So Russ, let's kind of take these one by one, starting with value. Value, of course, has been under a cloud for the better part of a decade. Why should investors make sure that their portfolios have at least some exposure to value stocks?
Yeah, I think value looks terrible right now any way you slice it. The gap, particularly between small value and small growth, but even large value and large growth, is enormous. And obviously, there's some good reasons for it. So, for instance, the companies like Amazon and Google are just taking away businesses left and right. Really, you think about retailers and the value side fighting with Amazon on the growth side, and we know who's winning that. As well as now we have a recession on, and that means value stocks tend to be much more economically sensitive. You think about a lot of manufacturers as well as banks, and so they're all having a hard time. And really, from the last bear market back in '09, growth has just crushed value. So it's in a way it's a hard case to make, but that's also, as a contrarian, you can also say, well, that's the reason you should have some, is that we know these things are cyclical, and historically, value has actually done a little bit better than growth. And I wouldn't bet the ranch that that's going to happen, but as you imply, it doesn't make sense to completely avoid it, because there are other times when value has done much better than growth. If we go back to some other bear markets and some other rallies, value often has had long runs against growth. And so when you think about diversification, that's the whole point, is you want to have these different elements that do well at different times. So I don't think you want to give up on value.
And how about foreign stocks? That's been a tough case to make for investors about why they should keep the faith in maintaining a globally diversified portfolio. But let's talk about your perspective on that issue.
Yeah, I think it's another area where you go in these cycles, and the U.S. has done better than most foreign markets lately. And then, of course, on top of that, the foreign markets sold off with the U.S. markets in February and March. So people might say, well, there's no point to diversification if they're all going to go move the same. But again, over the long cycles, we see foreign often does do better than the U.S. So I don't think it makes sense to avoid foreign. If you think about some of the great global brands, some of the great global companies, some of those are foreign. You think about some of the really strong growing economies like in China, and do you really want to avoid those? I don't think you should. So again, I think it makes sense to have some in foreign.
So for investors who want to make sure that they have exposure to these two unloved areas, you brought a few picks that bring both foreign stocks and value together. So some foreign value leaning stock funds. So let's start with the first one. That's Causeway International Value. It's gold rated. Performance doesn't look that great, certainly year to date, but you and the team have liked it for a long time. Let's talk about kind of the thesis for this fund, Russ.
Our basic thesis is good people, good strategy, but a strategy that's been out of favor for a while, and that's why you see poor performance. Harry Hartford and Sarah Ketterer have been running this strategy for a long time, and the long-term record is good, and they had a good record at a previous fund, but the more recent record here is not good. But I think they've got a very disciplined value approach that I think just really works well for long haul. And when value and foreign equities do come back, I think this fund has a lot of potential.
Okay. So this is one I know that has historically downplayed emerging markets equities. Is that still the case?
That's right. They have the unusual feature of avoiding emerging markets in this fund, which makes it a little bit different from your typical foreign fund, which might have 5 to 10 or 15% in emerging markets. So if you do go for this fund, you're going to want to find a dedicated emerging markets fund to add to your portfolio, most likely.
Okay. Let's talk about Dodge & Cox International Stock, also gold rated, foreign stock fund in the international large cap value category. Let's talk about why you and the team like this one.
That's right. This is another one where it's probably a hard sell because the record's not been great. But really all the fundamentals are there for this fund. Dodge has great managers. It's very much a team approach, great analysts who really make a career there, and really a good disciplined value approach. Not quite as deep value as Causeway, but they do like financials, which have been hit hard. But long term, this is just a very good fund. Virtually all the managers have $1 million or more of their own money in the fund. And so I think really an appealing fund, nice low expense ratio, which I love in an actively managed fund. So a lot of appeal outside of the recent performance.
One thing I noticed with this fund, Russ, is that it has a really nice yield. And I know a lot of people, especially retired folks, like yield. Is that a reason to investigate foreign stocks? Are the yields sometimes more attractive?
Oh yeah, especially after this sell-off, you do get a good yield. So I don't think you don't want to go out and screen on the highest yielding foreign equity funds, because that would be a really bad idea. But I do think it is a nice, appealing way to add a little income, especially now when a lot of your core bond fund yields have declined significantly, especially anything with government. So it's a nice way to add a little bit of income. Obviously, you have to recognize that unlike those core bond funds, you've got a lot of risk involved, and this is a long-term investment. But I do think it is an appealing way to get some income that people have probably overlooked.
Okay. Your last pick is T. Rowe Price International Value. In contrast with the first two, which I think we've talked a lot about over the years, this one may be a little less familiar. Let's talk about the thesis for this bronze-rated fund.
Oh yeah, it is a different story here. It's bronze rated, not gold, and it's only recently upgraded to bronze from neutral. The reason is T. Rowe was kind of in portfolio manager limbo for a while with this fund, as they brought in some interim managers and said they weren't sure who was going to run it long term. And then they broke from the T. Rowe mold. They hired Colin McQueen from outside of T. Rowe. He's someone with a 30 years of industry experience. So very good experienced manager with a good track record at multiple stops prior to T. Rowe. So even though he only came on board in 2019, we still have a lot of confidence. And of course, T. Rowe's got very good analysts. It's a fairly straightforward value fund of looking for good companies with good financials that happen to be temporarily out of favor, but we see a lot of potential there.
Russ, thank you so much for being here to provide these picks and to share your perspective on international and value investing.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar, Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.